We are now going to be looking at the definitions of contributed tax capital and the definition of a dividend. Very important that you understand these definitions, that you can apply it, and that you understand what it means. Now, before I continue with it, it's going to bring up something again, and that is to say the following, and this is, I think, where a lot of students just don't understand, or which they miss out on. If X Limited makes a distribution, so you distribute money, means you pay across money to its shareholders, please understand the following. You'll see now from our studies. That distribution will either be a dividend or it will be a contributed tax capital amount. Sometimes what you'll see, let's say they pay out 100 rands, it might be that 80 rands of that is a dividend and 20 rands of that is contributed tax capital. That's fine. You treat 80 the dividend and the contributed tax capital separately. Now there are different applications here. You need to now understand, you need to, when you are done with studying this, you need to say, I understand what is going to happen for X Limited when X Limited makes a distribution. And I also need to understand what's going to happen for the shareholders when they receive a distribution. So there's the payment and the receipt side of it. Pay attention to that, make sure that you differentiate the two from each other. So let's first talk about contributed tax capital. Now, what is contributed tax capital? I want you to understand, and this is maybe one of the more challenging things to get your head around first, but it's actually very, very simple thing, and guys, there's not that much that I can ask and test around this. Contributed tax capital is an amount that only exists for tax. They call it a notional amount, so it's like a pretend amount. Basically what contributed tax capital is it is the amount that the company received for the issuing of its shares. So if a company issues 1,000 shares at 1 rand a share, its contributed tax capital will be 1 rand times 1,000, so 1,000 rands. Now this, you might look at it and go, this is similar to what I know for accounting to be our stated capital or our equity and so forth. And yes, it is very much the same, but I want you to understand they are not exactly the same. So it might be possible that your contributed tax capital balance, which is a tax amount, is different from what you have for accounting for capital. Please be aware of it, they are not the same. They can be the same, sometimes they are the same, but they don't have to be the same. There are also situations, as you'll see, which we're going to see, where the directors can pay the contributed tax capital back to its shareholders. That's why I'm saying here distribution of a CTC. They can pay it back to them. And it's not the same as a share buyback, it's just they decide to pay back some of the CTC. So be aware that this is not the same as accounting. Okay, so let's start again. What is contributed tax capital? It is the amount that the company received for the issuing of its shares. Okay, so if you go and look at the definition of contributed tax capital in section 1, it tells you how this amount will be calculated. Now, this is not necessarily something I expect to see too much of. It can be asked. So the first thing I'm going to talk about is a contributed tax CTC calculation, excluding foreign companies. Right, so this is just for local normal companies. Dividends tax was introduced in 2012. So what they said is you take, on the 1st of January 2011, you take your balance of capital basically, you add all of the amounts that you received after that for issuing shares, you add any amount where shares have been converted from one class of shares to another, you deduct any amount that's been paid out, and you deduct if any amount has been changed and converted. Okay, so let me explain now all of these things quickly to you. There's a couple of important things here. So the first thing over here is that you need to understand that you need to have a separate calculation for each class of shares. So ordinary shares, preference shares, convertible preference shares, whatever they have, each of those classes, so let's say you had ordinary shares and preference shares. Each of these classes of shareholders will have their own contributed tax capital balance. I'm just thumb-sucking amounts here. But they will have their own balance. And you have to keep them separate from each other. So what they say here is, let's say this is on the 1st of January, you start here in 2011, You then issued some extra shares, some extra ordinary shares, let's say, for 20,000 rands. Let's say you didn't do anything there. Then you took some of these preference shares. So let's actually not call them preference shares. Let's call them convertible shares. Convertible preference shares. Right. You take some of your convertible preference shares, 5,000 rands of that, and you convert that into ordinary shares. So you see, you deduct there, added there. The directors, you'll see here, can make the decision. Remember, based on this at the top here, where I say the company can pay out dividends or contribute tax capital, this is a decision that the company will make most of the time. So the directors can make the decision and say, we are going to pay out 3,000 rands of our contributed tax capital from the ordinary shares, and we'll pay out 500 rands from our convertible preference shares. And that calculates then the closing balance, if you want to call it that, of this notional amount. So you might need to be aware of that and how to do that. Now what I want you to just see over here, there's a proviso that tells you that each shareholder is only entitled to the same percentage of contributed tax capital as his percentage shareholding in relation to the total shares. Okay, so what it means is, let's say you have contributed tax capital of 100,000 rands. That was the balance, what you've got. Now, X Limited decides to make a distribution to a shareholder. And the directors makes the decision. The directors say, we want to pay X Limited, or this shareholder over here, we want to pay him 50,000 rands, and that 50,000 rands will be 10,000 rands dividend and 40,000 rands contributed to tax capital. Now, if this shareholder, let's say is a 10% shareholder, then the shareholder can only get 100,000 times 10%, 10,000 rands back of its contributed tax capital. So it's impossible for the company to pay this shareholder 40,000 rands. It can't. It'll have to make that 40,000 rands 10,000 rands, and if it still wants to pay out 50,000 in total, then this dividend will have to be 40,000 rands. So the principle there is you can't receive more than your share of contributed tax capital. This same calculation, guys, I'm just repeating here. The only difference here is now we're looking at a foreign company that becomes a resident company after 1 January. So a company was formed in America, now it comes to South Africa. How do we know what its contributed tax capital is? So they say you start with the market value of the shares before it became a resident, obviously in South African terms, and then the reason is all the same. Any consideration that you received, you add. Any shares that have been converted, you add. Any amount that's been paid out, you deduct. And any amount that's been converted, you deduct. Same situation, guys, exactly the same, just foreign and local companies. Now, there are a couple of important CTC examples and principles that you need to be aware of. So I actually want to call this / principles. These are not contained in the Act. Necessarily, guys, they're not contained. This is principles that's been established already in terms of interpretation notes and how SARS has planned this and the general acceptance around it. So there's no real material around this. Okay, this is how it works. When a company makes a distribution to its shareholders, the directors will decide what portion of that is contributed tax capital. So that's my example I used where I said the company pays 50,000 rands to its shareholders and it decides that 10,000 of that is a div and 40,000 of that is contributed tax capital. The directors make the decision. They can only pay out the total amount of contributed tax capital. If the balance is, if it's been eliminated, it's been eliminated. Again, guys, make sure that you understand what I'm saying here. When the company decides to pay out contributed tax capital, it is not a share buyback. They are just deciding, they reclassifying that 50,000 rands as 10,000 rands dividend and 40,000 contributed tax capital. This is not something that we expect to see all the time to happen. You'll see there are implications around this. For the person receiving that contributed tax capital, it's not a dividend, so it's not exempt. So this is not something that we expect directors to just do all the time for no reason, but understand that it is possible from a tax act. Principle I've already said, each shareholder can only be entitled to their pro rata share of the CTC. If you pay for shares in a company by giving an asset to the company, you are paying, and you increase the CTC by the market value of the asset. Each class of shares has its own balance of CTC, that we said. And then important here, capitalization issue shares do not increase the contributed tax capital balance. What is a capitalization issue? That is where they say, okay, let's say there's 100,000 shares that's been issued by the company, and the company says for every 10 shares you own, we will give you 1 extra share. That's a capitalization issue. So 100,000 divided by 10, 10,000 rands. So let's just assume that it's the value of 10,000 shares is 1 rands. What would your accounting entry be for this? You would debit retained earnings and you would credit your capital, stated capital or share capital, however you call it in accounting, with 10,000. Now, the company now has 110,000 shares out. 100,000 was issued. That will have contributed tax capital because the shareholders had to pay for it. The 10,000 rands capitalization is not contributed tax capital. Why? Because it wasn't paid for. Usually you'd say debit bank and credit the capital amount. And that's why it's then paid for. They don't do it here. Here they take their earnings and they convert it into capital. So for accounting purposes, yes, that might be equity and so forth. It's not for tax. For tax, that is just profits, past profits that or retained earnings that you've now just converted and called something different. So why do we need to know what the contributed tax capital balance is? It's because of this concept that I keep coming back to. I tell you, the company makes a decision when it makes a distribution to its shareholders, and I say to you, that amount that the company pays to its shareholders, that distribution, can only be one of two things: a dividend or contributed tax capital. Now, why do you need to know if it's contributed tax capital? Simple. Because if it is contributed tax capital, it is not a dividend. And dividends are the ones of all the dividends tax rules. Contributed tax capital does not have that. It has its own set of special rules and implications, but it's not a dividend. Okay, so you'll see now when we look at the definition of a dividend, it specifically states that contributed tax capital is not a dividend. So here's the definition of a dividend. Very, very, very important definition, guys. Section 1. It says, a dividend means any amount other than a dividend consisting of a distribution of an asset in specie declared and paid as contemplated in section 31.3. Okay, so just a quick note here. Section 31.3 is the international transactions that are not taking place at arm's length. Make sure for your level 1 or 2, if it is applicable to you, if you are from any other university, it is definitely applicable to you. If you're a level 1 student, it is not. Section 31.3, so ignore those references. For those of you guys that have studied section 31, please understand that just say that dividend in specie that is deemed to have been paid is not considered a dividend, a traditional dividend here. Okay, so don't worry about that too much, guys. I don't expect that to be too much of a focus. So let's just start with the more important things. It means any amount, right, transferred or applied by a company that is a resident for the benefit or on behalf of any person in respect of any share in that company, whether that amount is transferred or applied by way of a distribution or as consideration for the acquisition of any share in that company. Okay, so let's just go up to there. So what are they saying? They're saying a dividend is any amount that is being transferred by the company on behalf or for the benefit of a person in respect of a share. So they're saying, if you are receiving something from the company, money, are you receiving that money because it is for a share? So, in other words, if you did not have shares in the company, would you receive this amount? So if you are receiving it only because you've got shares in the company, then it is a dividend. So let me explain. If you're an employee of a company and they pay you a salary for work that you've performed for them, that is not a dividend, because it is an amount that has been transferred for the benefit of a person, but it is not in respect of a share. It's in respect of work performed. So, a shareholder of the company who is also doing work for the company and being paid a salary, the salary part stays a salary. It is only if the company goes and says, listen, only because of the fact that I have a share in this company, can you get this amount, that it becomes a dividend. And then very important, that dividend can either be by way of a distribution made. So my example I keep using, X Limited pays to its shareholders 50,000 rands. That 50,000 is a dividend or contributed tax capital. So if it's not contributed tax capital, ignore that for now. That's what we refer to here as a distribution. Now, important, X Limited announces that it will buy back 10% of its shares. Let's call that 10,000 shares. Right? They say they will buy back 10% of the shares. They will pay 5 rands per share. Now, the directors indicate that 3 rands of the 5 rands is contributed tax capital. So in other words, they pay out 5 rands. 3 rands of that is, the directors say, we're paying you back actually your contributed tax capital. They don't have to do it, but they can say that. So that means the remaining portion of that is a dividend. Why are you receiving this 5 rand? You're receiving it in respect of shares. 3 rands of that is not a dividend. It's specifically called the contributed tax capital. So the remaining portion must be a dividend. That's the principle there. So then it says, so that's what we've seen up to there, but it does not include an amount so transferred and applied. Here we go. That results in the reduction of contributed tax capital. So in other words, can you see here, guys, all of these things are not dividends. Contributed tax capital. Shares in the company. So they say if you give shares out in the company, it's not CTC. Why? This is the capitalization shares that I spoke of. Do you remember that one where they went debit retained earnings, credit capital? It's also not a dividend. So it's not CTC and it's also not a dividend. Okay, the reason for that is it has its own special section which tells you that its shares have a null value. Okay, but for now, just understand it's nothing. And then, guys, the last one is a share buyback. This is number 3. It's a share buyback by a listed company. So it says it's an acquisition by the company of its own securities by way of a general repurchase as described in the JSE listed requirements. So in other words, if a listed company buys back its own shares, so I go back to this. So this X Limited, guys, remember X Limited does not mean it's listed. All listed companies are limited, but not all limited companies are listed. Okay? If X Limited was limited or listed, then this could not be a dividend. Okay? Specifically just in terms of this requirement. So guys, here's a summary of dividend and not a dividend. So a dividend is any amount which you've applied because of shareholding. So that can be cash they give you. If they give you a special loan, if they give you stock, if they give you assets, if they write off your debt, and they say all of those things because of the fact that you own shares, then it's a dividend. And it includes amounts paid to the shareholders in terms of a buyback. What is not a dividend? Contributed tax capital, shares issued by the company, share buybacks by listed companies, and any amount which is a fringe benefit. Okay, so that you'll study in future as we get to it. So now, very important. This slide is so important, and you'll see this pop up. This is to tell you what will happen for the person who is receiving this. Make sure you see that. Now remember, I said to you, if a company makes a distribution, that distribution is either a dividend or contributed tax capital. That still applies. It's either a dividend or contributed tax capital. Right, now, remember, you're holding shares in the company. Are you holding the shares in a scheme of profit making? So are you a share dealer? Here's the two situations for share dealers. Or are you holding it as an investment, so it's capital in nature? So if you receive a dividend in a scheme of profit making, it's gross income and it's exempt. If you receive it as an investment, it's gross income and it's exempt. Why? Because a dividend's a dividend, guys. So in your calculation, you'll put it in and you will exempt the full amount. I want you to see, guys, that is still exactly the same. So it doesn't matter if you're a share dealer or if you hold it as an investment. A dividend's a dividend. That we all know. This, if you make any mistake here, you're confusing yourself. This is not different from anything that you've studied up to before this point. Contributed tax capital, it's a little bit more challenging. If you receive contributed tax capital in a scheme of profit making, it will be gross income, but it will not be exempt. Right? So you'll say contributed tax capital, 100 rands, and it's not exempt. Why? Because it's not a dividend. But if you receive it as an investment, you will have to apply paragraph 76 capital B, and that's a section that you will be studying on your own. For now, I just want you to flag this. It's an important slide to get back to. This summarizes nicely what happens for the recipient, and this is something that students quite often confuse just because they don't break it down into this and because students forget that it's either dividend or contributed tax capital.